You're listening to Capital Topics, episode number 53. This is a monthly podcast about passive asset management and financial and tax planning ideas for the long-term investor. Your hosts for this podcast are James Parkyn and me, François Doyon, Rochelle, both portfolio managers with PWL Capital. In this episode, we'll discuss the following points. For our first topic, we'll review and comment on the report from the Howe Institute on RRIF mandatory withdrawal rules. And next, for our main topic, we'll tackle the debate regarding the classic 60-40 balanced portfolio. Enjoy! Good morning, James. How are you today?
Good morning to you, François. I'm very good, thank you.
Great. So in our first topic today, we'll discuss a recent report from the Howe Institute that highlights the need to revamp the rules surrounding registered retirement income funds, RRIFs, withdrawals because demographics and economic realities have changed since the rules were introduced. The report from Howe is entitled Live Long and Prosper, Mandatory RRIF Drawdowns Raise the Risk of Outliving Tax-Deferred Savings.
Yeah, well, François, this report from the Howe Institute comes at a time when many industry groups are being consulted regarding a study on RRIFs initiated actually by the Department of Finance. Mm-hmm. So this study, on which the Department of Finance is expected to report back to the House of Commons, I guess sometime in June, will review whether the underlying assumptions regarding rates of return, inflation, and longevity continue to be appropriate.
Yes, and before we go into the details of the report, let's provide our listeners with a brief refresher here on the mechanics surrounding mandatory RRIF withdrawals. So when you have a registered retirement savings plan, you must convert the account before December 31st in the year you turn age 71. You have three choices. The first choice is to convert to a RRIF, the second to purchase an annuity, and the third option is to withdraw all the funds as a lump sum, fully taxable, and close the account.
Okay, so although you have the option to withdraw or buy an annuity, the vast majority of RSP holders really convert to RRIFs.
Yeah, exactly, James. And once you have converted your RSP to a RRIF, you're required to make minimum annual withdrawals from it in the next calendar year after it was opened. This minimum amount to withdraw is set in the Federal Income Tax Act. The minimum annual withdrawal is calculated based on the fair market value of your RRIF on January 1st of each year, which is then multiplied by a percentage factor based on your age. It's important here to understand that this percentage factor increases each year as you get older. I'll give you an example. So suppose a client converted his RSP to a RRIF in 2022 when he reached 71 years old, and the market value of the RRIF on January 1st, 2023 was $1 million. Then, for 2023, the RRIF holder would have to withdraw a mandatory minimum of 5.4% of his RRIF. Therefore, he would need to withdraw $54,000 of the RRIF. So, as mentioned before, this percentage factor increases annually as you get older to reach a maximum of 20% when you turn 95.
So again, most people have saved and put money into their RSPs during their working years, and they really expect to draw a regular income from that pool of money during retirement. But what's at the heart of the discussion here right now is really the mandatory minimum RRIF withdrawal and the risk that these minimum withdrawals will deplete these savings too quickly given people's much longer life expectancy.
Yeah, you're right, James, in mentioning that. However, what the report highlights, and I'll give you our listeners some numbers later in the podcast, is that it's really the combination of the mandatory withdrawals and the fact that seniors live longer combined with the current lower real returns that are increasing the risk of seniors outliving their money.
François, I agree, but on the other hand, it's important, however, to mention that although you may be required to withdraw more money from your RRIF than you need, you can always reinvest the money withdrawing. In this case, if you don't need all of it for your living expenses, then you can reinvest in your taxable account, or even better, into your tax-free savings account if you have not maximized your contribution. Again, this is part of what we call retirement income optimization. But again, we're stuck with those minimum withdrawals, whether we like it or not.
Yeah, it's a good point, James. Now, I think it's important for a listener to understand that the initial framework is establishing minimum RRIF withdrawal dates back to 1978. There have been occasional changes since then, namely in 1992, 96, 2007, and more recently in 2015. These small tweaks concern either the age at which you had to convert your RSP to a RRIF or the withdrawal formula. So the Howe Institute, in their recent report, they propose a major overhaul.
Well, so I believe the federal government has realized the stress these mandatory minimum withdrawals put on seniors' savings. For example, in 2008, during the financial crisis, and more recently during the COVID-19 crisis, when markets dropped dramatically, they temporarily reduced the mandatory withdrawals by 25%.
Yeah, I agree, James. Those measures were timely, but did not address the fact that people live longer and the fact that real returns on safe assets are much lower now than in the past. The Howe Institute, in their report, demonstrate how the withdrawal rules interact with longevity and portfolio return. To give you an idea of the interaction, here is some data from the report for two scenarios. I will review and compare the first 1992 scenario versus the current scenario. In 1992, the report underlines that the real yield, not nominals, the real yield on a portfolio of Government of Canada bonds, which are very safe, was 5.7%. The yield on the same bond portfolio today is a meager 0.6%. The impact of this yield decrease means that under the current rules, a 71-year-old of either sex would likely see the value of his or her RRIF decline by 50% by the time they reach age 84. In the 1992 scenario, based on the yields and longevity assumption at that time, the value of his or her RRIF would fall by 50% by the time they reach 91. That's a 7-year difference.
That's just huge. Absolutely huge, François, So, but I'm not surprised. The change in real yield is enormous. We've been living that, seeing that in the portfolios, and up to recently, we had fairly low inflation, but now with much higher inflation, it changes everything. So we also touched on that point on our last podcast, number 52, when we covered Credit Suisse's Global Investment Returns Yearbook. We highlighted then that the real return on the World Bond Index in the last 40 years is probably abnormally high at 6.3%, especially when compared to world equities at 7.4% for the same period. The fact that real yields on safe assets are low is pushing seniors to have a larger weight in risky assets in the portfolio, making them more volatile and subject to losses at the same time that they're taking money out. So that's a twofold blow to their pool of assets when that happens.
Yeah. This large difference in real returns on safe assets speaks to the dwindling value of portfolio over time. But the other strong argument for change is longevity. Back in 1992, the odds of a 71-year-old man or woman to reach 91 years old, the year at which they would see their portfolio decrease to 50% of its original value, was 12% for men and 29% for women. Under the current scenario, a 71-year-old man has 60% chance, and a 71-year-old woman has 70% chance to reach 84, the year at which they would see their portfolio decrease to 50% of its original value. This means a much higher risk of actually running out of money in the last years of their life.
And we know as they get on later in years, they got to pay for private healthcare, et cetera, that they need money in those years. So François, these numbers clearly demonstrate the impact of lower portfolio returns on the sustainability of retirement savings. If people are living longer, but their investment returns are lower, there's a higher risk of depleting their savings too quickly. It's crucial to address this issue and ensure the rules surrounding RRIF withdrawals reflect the current economic realities and demographic changes.
Totally. Another issue raised in the report concerns the federal government impatience to collect taxes as quickly as possible rather than wait for voluntary withdrawals or the death of the RRIF holders to collect. The report reminds us that there is a limit to life expectancy, but that on the other hand, the government will be there forever, therefore guaranteed to collect. The report even goes on to say, and I quote, "The subsequent establishment of income-tested clawbacks of old age security, OAS, benefits made that fiscal motive all the more compelling for the government. This is another example of the government wishing to accelerate collection of taxes, I believe.
Again, François, I totally agree with what you're saying. The mandatory minimum RIF withdrawals, with these rules, the individuals may end up pulling more money from their portfolios than they need, pushing them into higher tax brackets, therefore increasing tax revenues for the government. Additionally, the higher the mandatory withdrawals from the RIF, the higher the probabilities that you're going to get into the zone of old age security clawback rules. And so that's around 87,000 of income this year where they start clawing it back. So further impacting your retirement income, because that's a form of double taxation, in my opinion. These aspects of financial planning and tax optimization are constantly at the forefront of our discussions with clients. It's a big part of our value add doing retirement income planning, or what we call retirement income optimization planning, and our IOP. And, clearly one of the main goals is to avoid OAS clawback.
Yeah, totally. We do a lot of work surrounding these issues at year end to tax optimize portfolio withdrawals.
So, François, what are CD Howe's recommendations to help seniors?
The first pair of recommendation is to raise the initial age of withdrawals and the age at which the minimum withdrawals reach 20% annually. The third recommendation is to lower the required minimum withdrawal. They suggest that the withdrawals be reduced by 25 or even 30%. The CD Howe also recommends that there should be more regular reviews to consider changing yields on safe assets and change in longevity.
So the CD Howe report recommendations to me, François, appear to be sound. However, it's clear that any reform of the withdrawal rules will have to be a balance between the broader implications for both retirees and the government with its revenues. So the ultimate solution would address the risk of retirees outliving their savings while also considering the impact on government revenues and also on one of its largest expenses. In fact, I believe old age security is their largest outlay, and it's increasing. So to me, the RRIF rules and the old age security rules are going to be all going to be linked.
Yeah, absolutely. And by striking the right balance, we can ensure retirees have sustainable income and financial security in their retirement, while also addressing the government's concern about their tax revenues.
So we'll see what the upcoming report from the Department of Finance offers to address these complex issues. But from my point of view, I think a more personalized and adaptable approach to withdrawals would help mitigate the risk of depleting savings too quickly and give seniors more flexibility and control over their finances.
I agree. It will be interesting to see how government responds to these recommendations and what changes will be implemented to strike the right balance with the changing realities of retirement. We'll make sure to update you in another podcast when and if changes are announced. Okay, now for our next topic, or the main topic for today, we will tackle the current debate over the classic way of building a balanced portfolio, which is an allocation of 60% stocks and 40% bonds. Our listeners should know that some of the best known names in the asset management industry are taking opposite sides in the debate.
Yeah, well, the debate's really, really interesting for many reasons. And again, it's hitchhiking on the last topic, which is lower expected returns, and we're getting back to the inflation, what's going to happen with that. So before we outline the opposing viewpoints, François, we should start with explaining the basics of a balanced portfolio. Some of our listeners may not know what that means. So the foundational 60-40 portfolio, where 60% is invested in stocks and 40% in bonds, is really the initial starting point for a discussion for allocation of portfolios with clients. We go through a rigorous process to assess a client's profile to come up with a long-term asset allocation recommendation that's personalized. The balance of this 60-40 mix is then adjusted. So it can be higher equity or lower equity, and you need more safety with higher fixed income. So really all of that, is based on an investor's time horizon, their risk tolerance, their risk capacity, and their financial goals. But the stock-bond combination is always at the core of what is considered a diversified, balanced portfolio, with bonds considered the safe component and stocks the risky or volatile component.
Yeah, I would add that generally the 60-40 portfolio is expected to provide diversification because when stocks have been down, bonds have generally increased in value. That didn't happen during 2022, largely because of high inflation created in the aftermath of the global coronavirus pandemic. The resulting interest rate hikes by central banks sent prices of bonds falling. A 60-40 portfolio for U.S. investors had one of its worst years ever because the bonds didn't do what they would normally have done in the prior 40 years.
Yeah, and our regular listeners know we've covered the topic of how rare the combination of both stocks and bonds dropping in the same year has been. I also recommend, some of our listeners who haven't had a chance to look at my recent blogs. The one in particular, the silver lining from a tough year in the markets, is higher expected return. So that's also available on the podcast website at capitaltopics.com.
Yeah, that's a good one.
The title is really the message. Last year was an example of short-term returns coming in far below long-term expectations. Again, for both stocks and bond markets, both asset classes fell by double-digit percentages for one of the very few times in history, only really 4 times. As reported by BlackRock. So it is normal for investors to question the soundness of the 60-40 portfolio. And again, a friendly reminder for our listeners to beware of the recency bias effect. We have also addressed this in our recent podcast.
Yeah, exactly right. 2022 was a painful year for investors, but the silver lining is that those market declines improve long-term expected return, especially for bonds. Our colleague Raymond Carzero stated in our podcast number 50 on expected returns, higher bond yields in 2022 produced a remarkable increase in our estimates for expected bond returns going forward. It climbed to 4.15% a year from 2.5% the previous year. James, you've been calling this a normalization of interest rate as compared to the pandemic central bank engineered ultra low rates.
Yeah, I've said that a lot. So in our podcast in the last 15 or 18 months. So François, I think it would be helpful if our listeners get a little history of why a 60-40 portfolio has been so popular for so long. My answer is simple. It's provided a really solid return with a modest amount of risk, and the bond returns were really the magic component sauce in all of this.
Yeah, I agree, James. The 40-year bull market in bonds that ended in 2021 is a big part of the explanation. There was a recent Morningstar investment conference I believe in Chicago, where one of the speakers noted that the trend that made the 60-40 portfolio successful for so long was declining interest rates. He cited, for example, in the case of an American-based investors, the Barclays Aggregate Bond Index returned 7.75% annually over the 40 years ending 2021. The result was that investors were able to receive 87% of the return they would have received if just investing in shares, but with 45% lower volatility. The protection offered by bonds didn't come at the cost of sacrificing returns.
Well, there you go, François. I mean, the 60-40 portfolio did the things that investors wanted, a great return with modest risk. But as we discussed in our podcast number 38 in 2022, when we reviewed that year's Credit Suisse yearbook, and we highlighted that the negative correlations between stocks and bonds was actually not the long-term norm, despite what the more recent 20 years at that point had demonstrated. So the 2023 yearbook, the one they published this year, it also reiterated that stocks and bonds have a historically positive correlation, and that the last 20 years of negative correlation before 2022 was actually not the norm. So again, very important, for investors, dealing with recency bias and have doubts around 60-40.
So, Jane, is it fair to say that bonds will continue to act as a stabilizer in the portfolio, helping to edge against the higher volatility of stocks?
I mean, that's the great question, because what you believe to be the answer is where the debate about the 60-40 portfolio starts off.
Yeah. And while in my view, in the 60-40 portfolio allocation, bonds provide 3 very significant benefits. 1 is the lower volatility. 2 is the annual income stream. And 3, and most importantly, the return of your principal. But be careful, not all bonds meet this standard, so investor must be very careful when building out this component of their portfolios.
So here are the battle lines in the debate. On the one hand, you have the believers that the balance mix still makes sense as a starting point for many investors. and that's a robust, allocation. On the other side, you have money managers who believe that alternative investments such as hedge funds, commodities, private equity, and inflation-protected assets can provide additional diversity beyond stocks and bonds. In effect, the latter group is saying we don't trust stocks and bonds completely to do the job of providing income growth, inflation protection, and downside protection anymore.
So, James, who is on which side of the debate?
Okay, well, like you said during the intro, some of the biggest names in the global asset management business are on opposing viewpoints. On one hand, you have Vanguard, and can you believe it, Goldman Sachs. And on the other hand, you have BlackRock. Again, it's among the biggest names in global investment management. So,
okay, so why don't we start with Vanguard? What are they saying?
Well, Vanguard believes in the 60-40 portfolio, François. Ziki Tan, a Vanguard investment strategist, in a recent report on the topic, stated, with these more favorable valuations, Vanguard's modeling shows that the return outlook and the worst case risk scenario for the 60-40 portfolio have notably improved. These improved valuations obviously came as a result of the 2022 negative market returns in both asset classes. So Vanguard produced a chart in their report on the 60-40 portfolio, and it shows the range of expected annualized returns over the next 10 years for a global 60-40 portfolio. And so it was interesting because they showed what their expectations were for as of 21 and now as of 22. So again, those expected returns have improved dramatically, and actually the downside risk is also significantly improved. So let me share some of the data points from Vanguard's report. So in 2021, their expected annualized 10-year return was 3.83%. Now it's 6.09. That's like 2.26 percentage points higher. The expected 10-year median volatility, though, is gone up a little bit, but only 0.35% or 35 basis points. But importantly, their expected maximum drawdown in any given year has gone down to negative 40.97, a big drop from negative 46.73% in 2021. And the probability of a 10% loss in any given year is now at 39.49%, whereas before it was at 59.50. So again, a big improvement in the expected returns, but also a reduction in the expected risk or downside volatility.
Totally. So what's Goldman Sachs saying now?
Okay, so Goldman is, and this is their asset management division, by the way. It's really known as an investment bank. But again, they're a big player in money management as well. Goldman is arguing that the odd big loss, like the one that happened in 2022, is inevitable in any strategy, and that the 60-40 portfolio remains a valid basic approach. Goldman calculates that U.S. stocks and bonds both lost money over a 12-month period, just 2% of the time since 1996. And that's, I think, a very key statistic, François. Only 2% of the time they both went down at the same time negatively, and certainly not by the quantums in 2022. And again, it's from a U.S. investor perspective. The Goldman thinking is you might reasonably be upset that your investments were caught up in such an unusual loss, but you should make radical portfolio changes only if you think this is the start of something new.
I think what they're saying here is beware of recency bias. Recency bias is the tendency to overweight recent events, trends, and projecting them into the future while ignoring long-term evidence. Now, for the other side of the debate in the 60-40 strategy is BlackRock, the world's largest investment manager. What are they saying?
Well, here I'm going to quote Vivek Paul, who is head of portfolio research at the BlackRock Investment Institute, and in a recent report stated, again, speaking, to the point that the Goldman was saying, this is a different regime. The great moderation is over. A focus on any one asset allocation mix misses the point. A regime of higher volatility with sticky inflation needs a new approach to building tactical and structural portfolios. And BlackRock, go on to state in their report, the losses, the worst in nominal terms for a 60-40 portfolio since the financial crisis of 2008-2009, and the worst in real terms in a calendar year since the Great Depression, show that the structure is outdated. The success of the 60-40 portfolio may have come to an end with the basic math of the situation being unforgiving. End of quote.
We should address here the debate with the lens of capital market history. After 10-year Treasury yields peaked at 15.8% in 1981, they fell for 4 decades to a low of 0.5% in 2020, offering long-term capital gains to bondholders on top of guaranteed income. Better still, from 2000 onwards, stocks tended to rise when bond yields went up and fell when yields fell.
So, but the situation, François, today is very different, as we all know, than in the early 1980s. For example, 10-year yields can't drop more than 15 percentage points in the next 40 years because they currently yield only 3.5%.
What I understand from BlackRock is that it's reasonable to think that higher rates might last given the long-term upward pressure on inflation from deglobalization, demographics, and the spending to combat climate changes.
Yeah, and a lot of people buy into that position, so BlackRock is not alone in what they're thinking. BlackRock in their report highlight some capital market history as well to make their case, focusing on what we can learn from 1969. And they state in the mid to 1960s, as prices rose, the Fed belatedly shifted into inflation fighting mode by rapidly raising interest rates. The move eventually led to an economic recession and a period of negative returns for stocks and bonds. Bonds were able to provide a hedge to equities eventually, but only after the Fed had sufficiently snuffed out inflation. End of quote.
Yeah, the key lesson, according to BlackRock, is, and I quote, "Bond may be a reliable diversifier when economic growth is slowing, but not necessarily when inflation is increasing." Why? Because when stocks decline due to rising inflation concern, the Fed may simultaneously have to raise interest rates to slow inflation. In the end, bonds may lose out as well, potentially exacerbating losses in a diversified 60-40 portfolio.
So, to me, François, your viewpoint on inflation will dictate which side of the debate you're gonna agree with. If you feel that we're probably headed for a more inflationary future, then it makes sense to hold less in the way of ordinary bonds. But if you aren't sure, to me, the 60-40 portfolio is really a decent place to start your portfolio planning.
Yeah. A further argument for the classic 60-40 portfolio is that many of the things put forward as an alternative portfolio cushion to bonds also had a terrible year last year. You might think U.S. Treasury inflation-protected bonds would protect against inflation. This did not happen last year. Rising yields meant that since the start of last year, U.S. tips have lost almost the same amount as ordinary Treasury bonds.
Again, you would never have predicted that one because Treasury, tips are supposed to protect you against inflation. But again, it's all a function of the price action in the market, right? Yeah. It's really the same story for private markets that are not mark to market. And a lot of noise in the financial press about private loans and private debt and private equity. But
it's not dealt every day, so.
Yeah, well, being private could mean the fund manager doesn't tell you that you've actually lost money, but the value of a loan or a company has gone down as interest rates have risen, no matter whether the company is private or listed. So, we're all dealing with the same economic realities, and fees are far higher in these private funds. So to me, most of the strategies proposed to tweak the classic 60-40 portfolio are simply not evidence-based and are highly influenced by their recency bias.
Agreed. And interestingly, so far this year, the 60-40 portfolio is up about 6% as of April. Those investors who strongly believe that the 60-40 portfolio recent gains are merely a mirage should consider swapping their bonds for cash. James, our listener, may want to know, since rates have, as you said, normalized, how has the expected returns on the 60-40 portfolio changed?
Well, we shared with you, Vanguard's outlook, but taking the positive view that the 60-40 approach is still valid. Todd Schlanger, a senior investment strategist at the Vanguard here in Canada, told the Wall Street Journal that he expects the next 10 years will see the 64 portfolio continue to work, and he estimates that the annual 10-year median return for a diversified 60-40 approach will come in at about 5.4%. So a little bit different from the other Vanguard report for U.S. investors. This is...
In the PWL 2023 financial assumptions report, the classic balance allocation 60% stocks and 40% bonds has an expected return of 581 for the market cap weighted portfolio. So not very far from that 5.4%.
Exactly. So the PWL and Vanguard expected returns are in the same ballpark. Again, these are before PWL fees. I recommend our listeners to go back to our podcast number 50, where we tackled expected with returns with Raymond Kerzero as our guest. Now let's try and tie it all together for our listeners, François. In 2022, bonds did not play their traditional role of stabilizer, acting to offset the negative volatility in stocks. So the 60-40 portfolio floundered. And just as it periodically floundered during the 70s and early 80s, but this has been very unusual based on capital market history over many decades. As Goldman Sachs said, only 2% of the time since 1926. So your outlook on inflation will be an important consideration for how you build the bond allocation for your portfolio. Again, we're going to quote our colleague Raymond Kerzero, PWL, in our podcast number 50. He highlighted that now that inflation is back, we're in a new economic environment. If you feel inflation is sticky, then if your goal is to reduce volatility of your portfolio, well, his advice is to stick with short-term bonds. Our regular listeners know that we have always positioned the bond strategic allocation, not tactical, strategic, in short-term bonds. And finally, François, my view for listeners is that valuations, now that they're back in more reasonable ranges for both stocks and bonds, a 60-40 portfolio asset mix is an appropriate starting point, with the fixed income being short duration.
Yeah, you made a very important point, James. We have consistently maintained the discipline of being short duration and high quality with our bond allocation. This served us well in 2022. What we know from capital market history is balanced portfolio flourish when interest rates fall and the economy is sound. They also perform acceptably during recessions, but they cannot withstand inflation shocks that lead to sharply rising rates. Assuming central banks can keep inflation under control, a balanced portfolio will profit investors who stay the course, I believe.
Well, François, let's go back now to Larry Swedroe, American author who we quote often and we have tremendous respect for. Larry, in a recent article about recency bias, said it really well. Resisting recency bias is the key to earning the premiums available from all risky assets. That's because of all the behavioral biases investors must overcome, with recency among the most powerful. It's tempting to sell out of an investment that has suffered losses because it's easy to think losses will keep happening. Because premiums adjust on an annual basis, investors need to have a long horizon to realize the true economics of an asset class.
Mm-hmm. To conclude, James, our discipline, as our regular listeners know well, is to invest with the investor mindset focused on the long term. We don't want to be led astray by short-term noise in the financial media and the recent financial market volatility. This challenge is daunting and applies to all investors, including us, professionals. We have said it often in our podcast. It's simple to say, but it's not easy to do. We must always be cognizant that we can fall into the trap of trying to forecast the future.
Well said, François.
All right. So thank you, James, for sharing your thoughts and expertise today.
My pleasure, François.
So that's it for episode number 53 of Capital Topics. Don't forget, if you'd like to submit questions or suggestions for the show, please email us at capitaltopics@pwlcapital.com. Also, if you like our podcast, please share it with your family and friends. And if you have not subscribed to it, please do. Again, thank you for tuning in, and please join us for our next episode to be released on July 6th. See you soon.